Welcome back, everyone. Deep value stocks are stocks priced low at significant discounts compared to its peers and compared to its own historic value. Such discounts can occur because sentiment around the stock worsened, whether micro or macro related, even if fundamentally the stock might be doing well. Fundamental comparative analysis can help us uncover potential discount stocks. For example, we can calculate the average price to free cash flow of an industry to screen which stocks are trading at discounts, near average, or at premiums. You can create your own stock screener using Excel and Power BI. Check out my tutorial in the top right. I found these stocks thanks to my Power BI report. In this video, I want to review Flex Steel Industries, which is a retail furniture company headquartered in Iowa, currently trading at a discount when compared to the home furnishing average multiples. The industry average price to free cash flow is 12.3, while Flex Steel's trades at 6.2. But Flex Steel's annual free cash flow has exploded 49% compared to the industry growth rate of only 2.1. So this surface level comparative analysis shows that FLXS ticker is growing free cash flow faster than the industry but trades at a discount. We can say the same thing about revenue. The average annual revenue growth rate for the home furnishing industry is negative 5%, and the price to sales ratio on average is 0.7. FLXS grew annual revenue by 4.8%, but trades at a discount price to sales at only 0.37. Flex Steel trades at an EBITDA discount as well at 6.7 compared to the industry's 12. If we assume FLXS were to trade at the industry average one day, we can see an 81% return in this stock, a potential asymmetric investment to the upside as long as Flex Steel continues to execute. When looking at the financials, this company has executed. Their revenue has been predictable for the last 2 years, hovering around 100 million per quarter, and their gross margins has increased from 20 to 22%, meaning the company is earning more profit from its sales after cost of goods sold, meaning Flex Steel has become more profitable over time. Their balance sheet is strong as well. They paid off all their long-term debt, which is awesome to see. This enables them to focus on cash piling for strengthening their balance sheet. The net income has been spotty, especially in the most recent quarter, where a large asset write-down of 14 million occurred. But I expect this to be a one-time occurrence because of unsuccessful subleases for a factory in Mexico. Flex Steel leased a Mexican factory in 2022 to increase production, which was then rented to sublessors. Tariffs have cooled short-term demand, and these subleases have become hard to act on. Since this is a one-time write-down, I'm not too concerned with the net income. If you have been a fan of the channel, you would know I love free cash flow companies. Flex Steel is a positive free cash flow company producing 10 million in the most recent quarter. They used to be negative 8 million back in summer 2023, so they have been moving in the right direction. FLXS trades below the historic average price to free cash flow given these free cash flow results, meaning Flex Steel may be trading cheap relative to itself. There are some potential downsides with this stock. For example, tariffs impacting retail spending. Tariffs are a temporary hurdle in this market, and once more deals between nations are made, we can see retail relief. Retail is also a seasonal stock, so the stock performance could be partially tethered to retail sentiment and spend behavior. But this stock is already trading so low compared to peers in the home furnishing industry, making me believe there is an asymmetric opportunity here. I have other deep value stocks I want to cover on this channel in future episodes, so subscribe to the channel to not miss them. Thank you for watching this video. Let me know what you think about Flex Steel, and I will see you all in the next one.